The market is flashing red alert. Dow futures took a nosedive overnight as geopolitical tensions reached a boiling point. The specter of escalating conflict in the Middle East, specifically concerning Iran, sent a wave of risk-off sentiment across global markets. Traders immediately priced in supply chain disruptions, with shipping activity through the critical Strait of Hormuz reportedly declining. This geopolitical shockwave sent crude oil prices surging, fueling inflationary fears, and putting immediate pressure on equities. But then, the whiplash. In a stunning reversal, sentiment flipped on a dime following comments from former President Trump suggesting Iran was calling for a deal. The mere hint of de-escalation was enough to trigger a massive short squeeze and send futures roaring back. The NASDAQ, which had been under pressure, led the charge higher. This price action is a textbook example of headline-driven volatility, where algorithms and traders react instantaneously to geopolitical soundbites, creating a treacherous environment for long-term investors. Leading that charge was the tech sector, which appears to have shaken off its recent sell-off. Heavyweights like Nvidia and Dell, central to the AI narrative, posted a significant bounce, signaling renewed institutional buying. This bullish momentum was supercharged by a blockbuster deal announcement. Apple has inked a massive $30 billion agreement with chipmaker Broadcom. This move not only secures a critical part of Apple's supply chain, but also injects a huge dose of confidence back into the semiconductor space, which has been a key market bellwether. However, the AI trade isn't a monolith. Look no further than Meta. Despite making significant progress on their own custom chip development, the stock is under pressure. Why? Wall Street is getting spooked by the colossal capital expenditures. Meta's plans for a massive AI infrastructure build-out are raising serious questions about margins and return on investment. It's a classic case of show me the money, and right now the street sees a giant spending bill without a clear, immediate path to profitability, overshadowing the technological wins. The divergence in corporate fortunes is everywhere. Take Palantir. The data analytics giant saw its stock partner, Rackspace Technology, jump a solid 8% after the two firms announced an expanded partnership. That's the bullish catalyst. On the other hand, Palantir itself is facing headwinds in the UK, claiming a major police contract was wrongly blocked over perceived values. This highlights the complex blend of operational wins and regulatory or political hurdles that are shaping individual stock stories right now. Now let's pivot from single stocks to the biggest player in the room, the Federal Reserve. There's a new sheriff in town, Chair Kevin Warsh, and he may have just dropped a bombshell clue about the future of interest rates. While no forward-looking guidance was officially given, his recent remarks have been interpreted by analysts as an unmistakably hawkish signal. This comes as recently released Fed meeting minutes show policymakers are deeply split, creating a fog of uncertainty over the central bank's next move. The market hates uncertainty, and this internal division is a major headwind. Zooming out further, we see trouble brewing in the world's second-largest economy. China's latest data paints a picture of a two-speed economy. Consumer price growth is weakening, signaling tepid domestic demand and a cautious consumer. At the same time, producer inflation has surged to a near four-year high, driven by robust export demand. Investors are now viewing this divergence not as a temporary blip, but as a defining long-term feature. This imbalance has massive implications for global trade flows and multinational corporate earnings. This global instability is now directly threatening a cornerstone of the financial system, the US dollar. A major warning has been sounded. The historic bond market buffer that has long protected the greenback is fading. Major dislocations in US foreign policy are accelerating a de-dollarization trend among foreign central banks, who are actively seeking alternatives. The erosion of the dollar's status as the world's undisputed reserve currency would be a seismic shift, impacting everything from import prices to the valuation of U.S. assets. All of these factors, geopolitical shocks, central bank uncertainty, and global economic shifts, are culminating in a stark new reality for investors. Strategists at Charles Schwab just issued a major warning. The era of easy index fund gains is officially over. They argue that we are entering a new paradigm defined by more geopolitical instability, more frequent supply shocks, and sustained macro volatility. The buy-the-dip mentality that worked for a decade may no longer be a viable strategy. the warnings are getting even more dire. Some analysts are drawing parallels to previous bubbles, suggesting the dot-com crash, which wiped out $5 trillion in wealth, could be a mere blip compared to what's coming. They argue the confluence of debt, geopolitical fractures, and untested monetary policies means the next global financial crisis could be exponentially more severe. While this remains a tail risk scenario, the fact that such conversations are happening in serious financial circles is a signal investors cannot afford to ignore. So where does this leave the market today? Let's bring it back to the tape. The NASDAQ, despite the macro headwinds, is eyeing key technical levels. After bouncing off support, the index is now approaching a critical resistance zone. A clean break above this level could signal that the bullish momentum in tech has enough power to temporarily override the macro concerns. However, a rejection here could confirm the bears are still in control, potentially setting the stage for a significant leg down. All eyes are on this battleground. The bottom line is this: we are in a trader's market defined by extreme cognitive dissonance. You have bullish micro-narratives in AI and tech clashing with deeply bearish macro fundamentals. The path forward will be dictated by the tug-of-war between geopolitical headlines, Fed policy signals, and the resilience of corporate earnings. Stay nimble, manage your risk, and pay close attention to the key levels we've just discussed. The volatility is here to stay.